Good morning, investors and innovators, and welcome back to Rise and Shine, where we dive deep into the real essence of real estate investment.
I'm Irismar.
And I am Jim, and together we navigate the latest opportunities and trends shaping the real estate world.
Today's episode is nothing short of exceptional. We are honored to have Dalia Barsoum with us. Dalia's expertise has been a game changer for investors looking to navigate the complexities of property investment financing.
And with an impressive track record as a mortgage broker, Dalia Barsoum not only helped investors secure the financing they need to grow their portfolios, but has also been a pivotal figure in shaping investment strategies that withstand market fluctuations.
100%. Dalia's insights in the financial landscape are unparalleled. Whether it's optimizing your portfolio financial performance or unlocking new investment opportunities, she brings a wealth of knowledge and experience that our listeners, you will benefit greatly from.
Yes. So whether you're an experienced investor or you're just starting the journey in the real estate world, today's conversation with Dalia is bound to provide you with valuable perspectives and strategies to elevate your investing game.
Prepare to be inspired, informed as we delve into the intricacies of the real estate investing financing and uncover the secrets of successful investing with one and only Dalia Barsoum.
Yes, so let's get Dalia in here. Thank you so much for coming back, Dalia. It's great to see you.
Great seeing you guys.
Much different landscape from the last time that we spoke, which might have been early last year. We've gone through some real hurdles in the market, and investors are struggling and having a tough time, and we hear a lot of cautionary tales now.
Yes. Yes.
What are you seeing on the mortgage side? Are you seeing people scrambling for support, or is everything just going as smoothly as possible?
Everything is smooth and peachy and beautiful and calm. Oh, guys. So I'm seeing a couple of things. Here's the thing. I feel everyone is at the peak of pressure right now. And like a lot of investors in the investment community is at the peak of the pressure. And obviously, some portfolios have turned upside down with cash flow, and some investors have to figure out ways to offset that shortage in cash flow, especially if they were on variable rates where their payments have changed. And some have exhausted their reserves by now, right? So I'm coming across people who are at the peak of that pressure point. And the good news is the runway ahead of us is now short. It's no longer that runway with no light at the end. So that's the good news. Like, we're probably 6 months away from seeing some relief with rates based on the recent inflation reports and the sentiment with respect to rate cuts and the Bank of Canada's messaging around, rate cuts. So I'm seeing investors at that peak point still having cash flow pressures, trying to figure out, okay, how are we going to stretch until we get some relief? And obviously, there are different strategies that we use with investors to help them stretch or alleviate that pressure. So we're seeing a bit of that. We're seeing values come short on some refinances. So even if qualification works and an investor wants to do something on an equity takeout, we're seeing values in some cases come shorter than what the investor expected, because appraisers are lagging indicator, right? Like, they're looking back. So they're reflecting values from some slower times in the market right now. And when we see lower valuations, we're always trying to figure out, okay, with that appraiser, did they miss something? Did they over adjust for something? Is there anything we can give them to help them, improve the situation? We're always, not just taking the value at face value and going, okay, this is the value. So appraisals. And then thirdly, and sadly, we've seen some investors lose their portfolios because of very high leverage that, they tapped into in the past. And obviously lenders have tightened and values have shifted. And if someone has over leveraged significantly, they're dealing with a very stressful situation, and some investors sadly lost their portfolios as a result. So that's just a flavor of what we've been seeing. On the positive note, I've been seeing investors also step into the market and buy. So I'm seeing investors pick up properties because now you're getting better prices. And as much as the rates are high, picking up a property at a discount, although the rate is high, is better than waiting for the rate to come down and picking it up when the value is higher. So we're seeing investors making moves. We're seeing also investors play more in the multifamily space. So there is still activity, but we're seeing these other challenges that I just covered with you.
Yeah, and Dalia, now do you see this as being the tip of the iceberg, or are we kind of on the home free stretch now in terms of interest rates, or do you think that there's a lot more that's going to get uncovered in the following months?
I mean, in terms of interest rates, definitely there is light now at the end of this tunnel, and there is more certainty around the rate cuts. The recent inflation reports came in better than expectations. The last Bank of Canada meeting did imply that they're just waiting to see the rates do their work, and they stopped talking about hiking stuff. So the market is expecting some relief around the summertime, and it's more certain in that expectation given the inflation reports. Unless something funky happens between now and then, we should be on track, right? Nobody has that crystal ball, but we should be on track. So that is, I call it, I'm cautiously optimistic about the environment ahead. I'm not gonna say, yes, we're good, we're done. No, I'm cautiously optimistic. I'm seeing signs that the relief is around the corner, and there is more and more certainty that it's going to happen. So I'm cautiously optimistic, but in the meantime, renewals are coming up, clients are still under pressure, and we have to figure out what to do in between now and then. Some investors who have put their properties up for sale are not seeing their properties turn the way they used to turn in the past. So properties, were sitting on the market a little bit longer, but I'm starting to see some momentum. Like January has been showing some momentum in property, sales, for example, in some markets. So to answer your question, I think we're closer to the end than, the beginning of a bigger problem. That's my impression. In the meantime, for this last stretch, we may see some challenges with some investors, depending on whether or not they're going to be able to stretch to that point, in my view. Like investors who are highly leveraged, what are they doing? Some lenders want out. They don't want to continue, lending money, like private lenders, or those who want to continue are coming up with crazy fees sometimes, which adds pressure on investors. So again, it's a matter of, can we find solutions to help come on the other side? But I feel like the runway is short now. It's not as long as it was before.
Yeah, and I mean, I think we want to be clear with the people watching as well, that when we say that there's some light at the end of the tunnel now, that doesn't mean we're getting back to the 2% type of rates that we were looking at during the COVID years. And we're getting back to what the normal is. And I think that's around for a 5-year fix, that's around the 5.5, 5.75 kind of mark.
Yeah, so the expectation is that the rate cuts starting the summer are going to be over the next, 12 months are going to be at around 100 points cut.
Okay.
So right now we're sitting at 5 at 7 point something, take 100 points, that brings variable to 6 point something. And then over a 2 years period, we should be coming back to close to, fives, in the 5s, 4s. So it's going to happen gradually. I mean, the rate cuts are not going to all of a sudden go down by 75 points, right?
No.
But definitely what the Bank of Canada doesn't want to see is disinflation, right? So they have to be careful about the pace and magnitude of the cuts.
Yes. And what do you see that maybe that people that are getting mortgages that aren't getting the proper advice, they're not coming through streetwise mortgages, that they're going to elsewhere. What do you see mistakes that they're making when they're taking on a mortgage in this environment?
So the mortgage decision, the rate decision at the times we're in right now is very crucial, because we're at a point where variable is up here, and then you've got long-term fixed rates being more competitive than the short-term fixed rates, right? So in some cases, one would look at, if someone is just looking at rates, they're gonna go, okay, why would I take a variable rate at 7.2 versus a 5-year fixed at 5 point something? That's a huge, gap. Just the key here is the key mistake is to make sure that you're not locked. So what I'm trying to explain is, if you're just looking at the differential, that's the wrong way to look at rates right now. It's about understanding the direction of the rates and the likelihood of cuts and how far that is. So right now, based on simulations, and we run a lot of simulations, variable rate is actually making a comeback right now. If you were to make a rate decision and you can tolerate a higher payment right now on a variable rate, you're going to benefit more taking a variable rate heading into the next cycle over the term of the mortgage, compared to taking, let's say, a 1 year, like a 2 or a 3 year fixed. Okay. But if you don't have the tolerance to write it down, okay, then take a 1 year, maybe a 2 year, okay, so that you can get a lower payment right now, but at least you would benefit heading out from, the slide. If you take a 5-year fixed because it's the lowest rate possible right now, guess what's going to happen? You're going to be saving on a payment right now, but once the rate's going to start to decline, that payment is going to stay up for the next 5 years. It's going to cost you a lot more over the next 5 years, and you're not going to see any payment relief where the market is going to see payment relief. So that's a mistake that investors, could make. It's really important to understand, one, what is most suitable right now, and two, which term makes sense for the investor. But I would recommend 5 years variable if they can stomach a higher payment temporarily, or a 1 or a 2 year fixed as an alternative. But obviously everyone's situation is different.
And this is why, this is why everybody that's watching as well, this is why it's important to have somebody like Dalia, who's an investor focused mortgage broker, that can guide you, and her team can guide you through this type of environment and give you the proper advice when you're purchasing an investment property. It's really imperative that you have that proper team behind you.
Yeah, we would show you guys a simulation. Sorry, Irismar, I know you were going to say something. We would show you a simulation, but for real estate investors in particular, what the plan for the property is also influences the rate decision. I can sit here all day and say, take a 2-year fixed, right? And then what if that investor's plan is to renovate the property and flip it, or to renovate the property and, burn it, buy, renovate, refinance, rent? Then I've done them, I have not helped them by locking into a rate, because that's not going to enable the success of their strategy. So it's one thing to pick a term based on the rate direction, and it's another thing specifically for real estate investor to marry that with the strategy for the property.
Right.
Gotcha. All right. And there's a lot of new ones. Sorry.
Yeah, no, it's great. I just feel that, since we're talking into that market and the advice, what about if we are in a position where this was the year that we were expecting to refinance some of our properties? Are you seeing that happening right now? And what are, per se, the challenges that they're facing, aside from the rates that we just talked?
If someone is looking to refinance a property? Yeah. So earlier I mentioned that valuations are coming short on refinances. So that obviously translates into several types of challenges. One, it could be that investor is not going to recoup the money they invested into the property because the value is not coming through. Or it could be that they're getting some of their money back, but they're not walking away with money for their next deal. Or it could be, if they highly leveraged going into this deal, okay, because there were some mortgages on the street at 100% loan to value at some point, if they've highly leveraged going into this deal and the value did not lift off, then they could run into a situation where there is not sufficient equity takeout at 80% of the new value to clear the existing mortgage on the property to start. And if that mortgage is a private mortgage, then that makes it obviously a bigger challenge because private mortgages want out in a year, right? So these are three different challenges. It's one thing, to say, you know what, okay, I'm gonna sit on this asset for now, and I'll wait for the market to correct and I'll do my refinance later on to recoup. And it's another thing to not be able to, pay off a private lender. And that's where, we help clients look for alternatives. Are there other properties? Can we pay that lender partially and maybe leave a piece in second position? Can we bring equity money into the deal and deleverage? All of these things are potential paths to dealing with such a problem.
Yeah. And I mean, there's been some really big names over the past few months that have fallen into some trouble and gotten lost investors' money. It's been very scary times. Do you have, I mean, what is the best thing that an investor can do to protect themselves so they don't go into something like this? There's a lot of private lending. Private debt is one of the biggest growing industries right now. And it's a lot of new people are not educating themselves. They just are attracted to the high returns. What could you suggest perhaps to prepare them for what's to come?
Yes, so Jim, private money is a great tool for both those who want to lend and earn money passively and those who want to grow their wealth using, some creative type of money is what I would call it, and also to get around some of the tougher qualification challenges, right? So it's a beautiful tool, but it's a two-edged sword. And for lenders who are looking to lend money, okay, lenders got a good look beyond the double-digit returns is what I call it, right? It's not about making 17% or 20% and this fee and that fee. I came from a banking environment and I was taught early on, and I keep this in everything I do, it's risk return. So when something sounds too good to be true, or the numbers look fantastic, okay, what's the risk? What's the downside? What's the worst case situation? What does that look like? Have I looked at the property risk? Have I looked at the borrower's risk? Have I looked at the market risk? Have I looked at the exit strategy? And if you think with these principles in mind when you lend money, then you would reduce the risk of something blowing up and losing all of your capital. I mean, part of lending, there is always a risk. You're not going to eliminate it. The question is how much of that risk you can chew on. And are you in first position? Are you in second position? With all my respect, third and fourth position loans are secured against air most of the time, okay? If something goes south and markets turn, okay, be prepared to lose that money. If you lose that money, don't cry over it because that's the type of risk you took. So that's from a lender's standpoint. And obviously, if you're not experienced investor who's lending money, you want to lean on professionals who are doing this day in and day out. And don't be afraid to ask questions. Please do not look at a fancy presentation with someone dressed so well, who talks so well, and then you're just going, this sounds great. Remove that from your assessment. Ask questions. Ask, where is the diligence? I want to see the appraisal reports. Is it a third-party appraisal report? What's the exit strategy? Show me that you've done the diligence. Don't be afraid to ask questions, okay? So you gotta stick with that, fundamentals. And then if you're borrowing money as a real estate investor, and you're gonna use this money to build your wealth, and I've seen investors build phenomenal wealth with private money. My advice to you is two things. One, validate your exit strategy, okay? And what do I mean by that? So if you're taking private money, you have to lean on a professional to help you understand how you're gonna pay that money back. Or if you're experienced enough and you know how you're gonna pay that money back and you're very comfortable in, you know, taking maybe an application to CMC yourself, fine, but validate your assumptions. Where some things go wrong is where assumptions are made. I get investors who say, I'm taking this loan and my exit strategy is going to be to refinance with a bank at 80% loan to value at a 30-year amortization. Okay, sounds fantastic. Well, let's see if you would qualify to get a 80% loan at 30-year amortization. Let me run the numbers and validate. And in some cases, they don't. They think they will, but we run the numbers to validate the assumption and they don't. They may get 60%, not 80%. And now what? So for real estate investors, you've got to work with a professional to help you validate the assumptions through running the numbers, number one. Number two, how much of this money do you want to take? Okay, I've seen sadly, and I'm so against this and I've been screaming about it for a long time. High leverage on multiple properties that are being renovated with a portfolio floating in promissory notes. That is like a model for someone to come and do this, and then the entire thing falls. Very high leverage. It's like 100 and something% leverage.
Yeah.
You know, you can take high leverage for a short period of time, but when you now take it on multiple properties that are all in renovations, you increase operational risk. You're magnifying risk because there is high leverage risk. You marry it to market risk, execution risk. It's like risk over risk over risk over risk. And now that investor sadly puts themselves in a position where they're risking the entire wealth that they're really looking to build and work hard for. So manage your leverage, validate your exit. I work with a lot of high net worth clients, and I see a lot of balance sheets. And many investors think, oh, you know what, high net worth clients take huge risks to earn their wealth. Absolutely not. The lowest leveraged portfolios are the high net worth clients.
Yes.
50%, 60%. Yes, they use creative financing, but they would not risk creative financing on their entire thing. Absolutely not. If you look at a portfolio level and you take everything into account, like values minus debt, they're at a 50, 60%. It doesn't mean that one property may be highly leveraged or two or whatever, right? But at a portfolio level, they're at 50, 60%, if not less sometimes.
Gotcha. And I mean, what did we just learn this week? You said earlier there,
Yeah.
with through Mandy Branham, you know, take
what?
take the emotion.
Yeah, take the emotion out of it. You can't put emotions. You have to be practical. You have to evaluate the deal, assess.
Let the
look
numbers
at the
talk.
number.
Yeah.
Let the numbers tell you. And we as investors have to be able to answer those questions to our investors. And that's what working with someone like Dalia to validate the strategies, the exit strategies makes sense, because then we are better equipped to say, how is this investment going to work?
Yes, we can help you guys validate your exit on the commercial side, on the residential side, and also run scenarios. What if the renovation takes longer? What does that look like? Like these scenarios, right? You gotta run. It doesn't mean they're gonna happen, but at least you plan, you know, versus, and then if they happen, you're responding because you know, versus reacting.
Yes. Yeah, you want to be,
it's the worst thing. It's the worst thing.
you need to be prepared, and like you said, you also, you know, asking the questions, and don't be afraid to ask questions. Don't get blinded by the beautiful presentation and the well-dressed outfits and all that sort of stuff. It's really down to the numbers, and that's what it means. Take everything, ignore the noise.
Yes, ignore the noise, ask the questions, do your homework. I'm going to tell you something that is fascinating. I find that sometimes investors believe, if human beings in general sometimes believe something that gets repeated over and over and over, and if something gets repeated over and over and over and over and over, like for some reason people start to believe it. I find sometimes in the investment community that is a thing. Like if some people get, or if something gets repeated over and over and over in podcasts or whatever, or like certain people get featured over and over, people start to believe that's a good thing. Like that must be real. That must be good. And then they, okay, maybe it is, but okay, take that out. Ask your questions. Do your homework. Go back to basics.
Yes.
Don't be afraid. Just basics.
I think that was key. Going back to the basics, because even if we've been in the business for a long time, going back to those basics brings it back to that foundation. If I'm dealing with a new investor, now I need to go into it, the educator cap, the teacher.
Yeah. Yes.
Informative and being curious and asking the right questions. Now, if I am your high net worth client and a deal gets presented to me, I would likely will come to you and get you to tell me, is this a good investment for me or not?
Yeah.
And how would you validate that, right? Like for yourself, you now taking into account everything. And have you had clients that you said, no, that's not a deal for you?
I basically don't tell a client, this is a good deal, this is a bad deal. I put the facts on the table and I say, here is my observation. From what I know, here are the risks, here are the goods. Now you make the choice. I'm not going to make the choice for you. But the only thing that I've been really against and literally screaming about for years is this whole 100% financing on multiple properties that are being renovated with promissory notes around the portfolio. I have literally lost clients who came to me and said, Dalia, but somebody else is offering this. Why? I said, I cannot put you in a product like this where I know it's like a rope that you're tying yourself with. I can't. So that's the only time where I said no.
Yeah.
Bluntly to something.
No, and it's good. You have to stay true to yourself and you know, committed to doing the right things for people. And that's why, you know, people need to understand that, you know, even if they're starting off in real estate investing and they hear about these private offerings, that you should have a mentor, a professional, a coach, somebody that's going to guide you and give you the proper advice and steer you through here. So you ask the right questions when you come into this.
Yeah, absolutely, Jim. And another thing I can share with you guys, and this is part of the guidance that we do. On social media, you see portfolios, you see number of doors, you see, oh, this investor has 200 doors, this investor has 300 doors, and you think, oh my God, that must be like a lot of, you know, must be a lot of cash flow. At the end of the day, the debt structure is a big part of what the bottom line is going to look like, right? So structuring debt the right way when you're starting out and as you grow as an investor is huge in terms of helping you optimize your numbers, getting the return from your assets, manage your risks. And part of what we do is helping investors understand what's the best type of money to use at every stage of the journey and how to manage the risk when you use that type of money. Obviously, there is A lending, B lending, joint ventures, raising capital, private money, all of these, like when do you use what when, right? So we want to make sure that we're using the right tools at the right time and managing the risk. I've seen investors try to jump from starting out to using money types that investor level 5 uses. And it's like trying to run the marathon before even understanding what it takes to run a marathon.
Right.
That's that structure.
Yeah, it's incredible. I really hope a lot of people come out of this. There's been a lot of sad stories that have come out in the past few months, and you know, we hope that everything turns around for everybody. It's really sad because this is people's hard-earned money, right? This is things that need to be taken seriously, and really a lot of due diligence needs to go into it. I think a lot of people have been enticed by a second stream of income, especially during these times, and these higher rates or higher returns are really appealing. But due diligence and going back to the basics and understanding what you're getting involved with is really important.
Due diligence on both sides. And if
Yes, absolutely.
Yeah, no,
due diligence on both sides, and that is the criticality, right? Going to the fundamentals, but if you are starting this relationship is a business, and you are required to do your own due diligence. Just because someone is presenting you the deal and they're the expert, as Dalia goes back, don't take it verbatim. You have to do your own due diligence. That might be research, that might be checking with a professional, that might be getting a second opinion.
Yes.
Just
Yes.
with yourself.
Yes, and one lesson I've learned in business is getting independent legal advice. Okay, so you obviously put contracts together, but I always, pay that $300 or whatever that number is to get my lawyer to give me an independent legal advice, because sometimes the lawyer sees things I don't. Then it's up to me to say, thank you very much, Mr. Lawyer. You've opened my eyes on certain things I hadn't thought about, but I'm choosing to still go ahead. Or, oh, I didn't know that. I'm gonna now make sure that I cover for that, right? But independent legal advice.
Absolutely. And another thing that Irismar I have want to emphasize as well is make sure that they are a investor focused lawyer, solicitor, and just always have an investor focused professional on your team. They seem to understand the intricacies of these deals a little bit more. They deal with them a lot more often. So reach out for that. Reach out to us anytime, or Dalia, or anybody in your investing community to find these professionals. But absolutely. Now, Dalia, has there been anything exciting in the mortgage broker world lately? Is there anything new that investors would want to hear about?
Yes, let's talk about some exciting stuff now.
Ooh.
Okay.
On the exciting note, Bank of Montreal has decided to re-enter the mortgage broker channel, which basically it's great news, and they're rolling out their products in stages and working initially with a small group of brokers. Streetwise is the privilege to get early access, and they're coming up with 3 products that are of great interest to investors. So that's what I want to share with you guys. The first product is a product for pre-construction condos. If let's say you've purchased a condo a couple of years ago, or maybe 12 months ago, for $500,000, and the day of closing it's worth $600,000, which is common with new construction. The question I get from investors is, Dalia, how can I tap into the equity now that it's worth $600,000? Right? I want to get access to that equity because, why tie my money into the property? Traditionally, in the past, if you went to the banks and traditional lenders, they would lend you money on the $500,000, the lower of the two. They wouldn't lend you on the $600,000 unless you go to a private lender. Okay. Sometimes you had to close and take a variable rate on the $500,000, and then 6 months later refinance it at a higher value, or switch lenders. But what BMO's doing is they're saying from day one, if your property is worth more, we're going to lend you 80% on the appraised value, a 30-year amortization at bank rates. And what that does is basically a couple of things. One, you now may not have to come up with that extra payment that you needed, the last payment you needed to give the builder, because it's in the equity of the property. You can walk away with cash on closing that covers your HST if there is HST involved, or potentially, a surplus that can help you with your closing costs and future purchases. So it's huge. Bank rate, no need for private money.
So is BMO the only institution that's doing that out of the big 5, big 6? Okay.
Yes. Yes.
And so BMO recognizes the future value of the pre-construction condo, so that they're willing to help out this market, the investors in this market.
it's not the future value, it's, you're not gonna get a mortgage until the property is ready to register, right? Until it's not an occupancy, it's when it's ready to close, that's when you get a mortgage. So if the appraiser says the value is worth more than what the agreement of purchase and sales is, that's what they're gonna go by.
Okay.
Okay, so
All right.
that's a great one for investors. And then,
Exciting. Yeah.
and there are two more.
Oh,
Okay.
Yes, so the second one is for Airbnb and short-term rentals. They're okay with Airbnbs and short-term rentals. They would do 75% of the value at the 30-year AM at excellent rates, where the banks did not like short-term rentals. Like if you had a short-term rental that you're taking to a bank for a refinance, they would decline typically the deal. They don't like it. So BMO's saying, if you have an existing Airbnb or VBRO or short-term rental, and you've been showing that income on your tax returns, they're gonna consider that income. And it's not a no, they're gonna consider that. And if you're buying one that you plan to rent Airbnb, no problem. They're not gonna consider the Airbnb income on the purchase until you've established some history, but they're okay doing the deal and they will use market trends. So either way, it opens up doors for investors who are looking to utilize short-term rentals, mid-term rentals versus just, the traditional rental model with the banks.
Wow, that's a big one.
that one's really shocking me. I mean, with the changes in the STR space across the country, a lot of municipalities are cracking down on a lot of that, and it's getting. I mean, it was definitely an oversaturated market in a lot of areas, the popular cottage country areas especially. But that seems very interesting.
Yeah, I know. I mean, the cities are tightening, but BMO's coming up with a product to service that niche. So,
Oh, that's wonderful. Now, the last part you said there, in terms of if you're purchasing an SDR, they understand, they'll look at the market trends, but how will they apply that if you're looking at purchasing one?
so if you're purchasing one and it's in an area that
It hasn't had any history of an SDR. The purchaser's going to do that.
okay, they're gonna use market trends. They're gonna ask the appraiser of what it would rent for.
Okay, all right,
Yeah.
very good. That's exciting. Wow, that gives a lot of opportunity for investors.
Yeah, that's a good one. And then lastly, the third one is not as exciting, but still good news. Is the possibility of using gifted down payment on a rental property. A lot of the banks wanted to see that you as an investor have the 20% down from what they call your own resources. So that could be, a secured line of credit with cash or whatever. You have to show that that's your own money. And gifted down payment was only allowed on primary residences. So if I'm buying a house for myself to live in, I can go and get money from my parents, from my siblings, from my kids, from a close relative, and they're really donating some money to help me out. Now that is an option on a rental property with BMO as well.
Wow.
BMO is back with a bang.
I know, right? And they use actually a great percentage of the rental income. They use 80%.
Oh,
Okay. Wow.
Yeah.
wow.
So they're coming in aggressive with their offers. I like it because it does offer the community more options, but yeah, we'll see.
Yeah, because I mean, I think it was Scotiabank was more the investor-friendly lender, I feel, within the past few years. I know a lot of people have switched over to Scotia.
Scotia is still a very, very good lender for investors. Okay, Scotia definitely has their advantages. This is not about saying BMO's better than Scotia, Scotia's better than this is better. No, each lender actually has advantages, and part of structuring a portfolio is to determine how to tap into these advantages depending on where the investor are with their journey and how big their portfolio is. But each lender has its strength. The They're all banks, but they look at things differently.
Right. And this isn't like when, you know, for the investors that are watching this, this isn't, you know, about going into your bank and asking for a mortgage. When you're dealing with somebody like Dalia at Streetwise, this is a relationship. This is somebody that's looking at your total portfolio, understanding your goals, understanding your needs, and trying to find the best product suitable for you, whichever financial institution has that product. So that's one of the real true benefits of dealing with somebody like Streetwise Mortgages and Dalia.
Yes, I used to work for one of the banks. And when you're working with the bank, obviously, I'm not gonna go tell my client, go to the green bank next door, or go to the red bank next door. No, I'm gonna offer what's on the shelf when working for the bank. But as a broker, I work with many banks, with many credit unions, many private lenders, many alternative lenders. And at the end of the day, whatever is right for the client and their portfolio is what we're gonna recommend. And at times, I've sent clients back to their banks and I said, right now, just go back to this bank and tell them the following. And here is how you're gonna present your deal. Go do it there, and once you do it there, come back here because we're gonna go there. I've done that many times.
Oh, wow.
And as a broker, I actually have relationships outside of the broker channel, and I know, you know, I can offer investors products that are not necessarily just part of the broker channel. And like I said, I've done many times I've sent the clients back to certain banks and said, go do this and come back because that's the right thing for your portfolio. And then we continue from there. There is no point in taking an investor just to a limited set of products if there are better options out there.
Oh, wow. Oh,
Yeah.
I love that approach because then it's not just, oh, let's increase our business or let's increase our portfolio. You're really taking the time to cater and provide the solution that is unique to that strategy and unique to that investor journey. Because we're all our investors, but our journeys are not the same and our goals are not the same. So
Yeah.
I love that you share that example because that just brought it to mind.
Yes, absolutely. We deal Irismar with investors who are starting out, and we deal with investors who have tested the water and now they're going, oh, I like this real estate thing. I'm going to do a little bit more. And then we deal with investors who, you know, now love the rich dad, poor dad, and they want to build a portfolio and eventually quit their jobs. And then you have the investors who are, okay, now I want to take this as a business. I want to build my empire. I want to be like Grant Cardone eventually. So we deal with all of the investor journeys and all of the strategies. Like I've personally learned so many strategies just sitting at this desk, getting fascinated by what investors do. There are like 15 strategies. I have a big sheet of all of the strategies and the capital sources of structuring them from private money to developments. And it's just, I love it. It's fascinating.
well, for those of you guys watching, Rich Dad, Poor Dad is one of the first books you should probably be reading when you want to become a real estate investor. But it isn't the only book you should read. I mean,
Right?
Dalia has written a book here. It's the Canadian Real Estate Investor Financing
The 7 Secrets.
to Getting All the Money That You Want. So you wrote that a while ago, Dalia, but that's been a handy tool in our arsenal. So thank you for writing that and putting that. What was the inspiration behind writing a book?
At the time I wrote this book, there wasn't much on Canadian investor financing in the market. So I wanted to put something out there to help investors understand, you know, what options are out there when it comes to building a portfolio. Since then, that, you know, all of the things around financing and financing blocks, that became a common thing over the years. But when I wrote the book, there wasn't much on Canadian financing available. So that was my motivation to share what I've learned and put it out there.
Oh, beautiful.
Thank you.
And what is in the future for Streetwise for 2024? Anything in the works?
Yes, a couple of things are in the works. I'm working on my second book. It's going to be about private money, and it's scheduled to launch in the fall. And I'm going to be covering both the lender and the real estate investor, you know, perspectives. and sharing lessons and stories, good, bad, and ugly in the book on both fronts. And then teaching how to utilize this tool to really build wealth, because I have, folks in their 70s and 80s living outside of Canada on islands doing private money to support their lifestyle. And I have people who come here who said, oh my God, we've lost money. What can we do? So all of these things I'm putting together in a book to shed light on this particular topic, especially given the recent circumstances that we've all seen. And then we're looking to grow as a business. I'm looking to probably expand our advisory arm to be able to help more people. So that is something that is going to be exciting for us.
Wow.
Exciting.
Yes, more value to all the clients and the community. That's wonderful.
And extra support for those seeking it. So if you feel like reaching out to Streetwise, then go ahead.
Yeah. How can people get in touch with you, Dalia?
Our website is streetwisemortgages.com. We have a contact form there, or they can email us at info@streetwisemortgages.com. And like I tell everybody, whether you want a second opinion, whether you're scaling a portfolio, whether you have a challenge right now that you don't know how to deal with on the mortgage side, we'd love to support you, and we know that we can help you, because we don't just take things, plug them into a calculator and go, oh, no, it doesn't work. Oh, no, I always think, how can I make this work? Okay, the question is not whether or not it works, it's how can I make this work? And this is how we work, we ask the question and we then think about the different ways to connect the dots for investors. And that's why we've grown over the years, because many times clients come to us and say, oh, I was told no. And then we open up capacity for 5 or 10 more properties, because we ask a different question when we problem solve.
Yes. Well, that is the investor mindset, thinking of how to find a way to achieve something rather than just saying, no, I can't do it. This isn't for me.
That's right. Challenge your thinking, challenge your perspective, and get those advice if you don't know if it is right or not. That second opinion is valuable.
Absolutely. Well, thank you so much, Dalia, for hanging out with us today. That's wonderful. Shared so much value. You guys reach out to Dalia at Streetwise Mortgages anytime you want to get some proper real estate investing advice, and we will see you next week. Dalia can hang out for just a moment.
Have a good week, everyone.